Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look and see what people are sharing. So let's get to it. You can find me at Finance Core Finance, and you can join our community, finding-value.com, if you are more interested in finding out how I'm playing this commodity bull market. I go deeper into individual companies, macro, and answer a lot of your guys' questions that you have with my opinions. We do have a coupon code Mayday that is still active. We've got Jordan Roy Byrne. Gold's cup and handle breakout was significant. The coming breakout in the inflation adjusted gold price. One of the biggest breakouts of all time. Gold versus the consumer price index is best fundamental indicator for gold stocks. So we could potentially get gold to outperform the consumer price index here on a monster breakout going back all the way to 1980. This is a huge, huge deal. And what this means is that gold's going to outperform inflation, which is good for mining companies. The reason mining companies have sucked for so long is because of this chart. They haven't been able to put together a massive outperformance against inflation. So their margins haven't really had the chance to expand. But it looks like what could be coming for gold and the outperformance against inflation, which would be an inflation adjusted gold price, could prove very well for the miners. And the miners, the mining companies, are at incredibly low valuation levels against gold and silver itself. So we have an incredible opportunity right in front of us to partake in what I think is a once or twice in a lifetime opportunity for gains in the gold and silver mining space. Garrett Goggin, and I agree with his opinion here. He says, no surprise here when the yield curve rises or uninverts, the market crashes every time. The Fed steps in and is forced to cut rates and expand its balance sheet. Gold is the place to be as it will double over the next few years. Completely agree. So when I look at these things, it's not just one chart. Oh, it's this one particular chart. No, it's not this one particular chart. It's in addition to the yield curve, uninverting, steepening and uninverting. And that in gold is the spot to be when these market conditions are present that we are in today. This is it. And you've got this ridiculous looking chart here. Guys, I stare at this chart because it is so awesome. You don't get to partake in some of these breakouts like this very often in your life. It is clearly a huge opportunity if you know what you're looking at. Joseph says a market sell-off is worse than a divorce because you lose half your money, but your spouse is still around. I thought that was funny. I really did. It is funny. Looks like this guy wants my opinion. He flashed me here, so I can share it. So this is the global X uranium. They're looking at the potential sell-off here to the support level, which is like a 200-day moving average, I think is what it is. Yeah, the 200-day moving average. So what's my opinion on this? Well, we've fallen down quite substantially here. The thing that gets me a little bit worried is what I just went over here. It's this yield curve coming up. That's what's driving all of this, I think, fear in the market. Yes, the yen is unwinding the carry trade and all that stuff, where you borrow cheap yen and convert it to other currencies and invest. But when this uninverts, a lot of things fall, including our guys in the uranium sector. It's also impacting a bunch of other sectors. The market conditions when this uninverts is not ripe for uranium necessarily. It doesn't mean it can't go higher, but it's not a full tailwind. It's not like we've got a bunch of inflation in the system. The rates are increasing. That's the opposite market condition. That's when uranium was flying, was under that market condition back here. Then it started to slow down, and that's kind of what we got here. So this is a big pullback. It is coinciding with the yield curve uninverting and steepening. And I think the market conditions that could be coming could still weigh on this for a little while. So that's my opinion. My opinion could very easily change if we see the yield curve doesn't invert. Like if we stay inverted, it doesn't invert, maybe we can get a bounce and move higher. Um, but every time in history, uranium did its big moves before the yield curve uninverted. Like it would end its move when the yield curve started to uninvert. I think that this here is the beginning of the move. We get a bear trap, so to speak, come, and then we are going to rip because the response, like every other response, the Fed is going to step in, cut rates. That's when gold goes up. Gold front runs the move of uranium and oil and all that. They're going to print a bunch of money. Gold and silver are going to account for that money printing. And then, just like last cycle, uh, about delayed a little bit behind gold and silver, oil and uranium is going to rip. This is going to be a bear trap. That is my guess, if you want my opinion. JC says, sometimes I get accused of being insensitive, and it's not that I don't think what the market is doing is a big deal. It's that I've seen it before so many times. It's just part of the cycles. Don't misconstrue my composure with a lack of understanding. I'm just numb to it now. And that's where you want to be. I've seen some pretty big declines in my portfolio. You're not going to go from an original investment to your final selling, selling out of that investment and not go through 20, 30, 40, 50, 60, 70% pullbacks. In the stuff that we're in, you're going to have those pullbacks. It's the way it is. And you have to become numb to it because you see it so often. And I know some of the account values they can swing very large. And I know some people are going to say, you know what, I'm up or I'm down. I've lost more money in market swings per day than a year's worth of salary. And that is very common as you get older and you accumulate more wealth. Those swings are part of the game. You're not losing money because you experience the swings. The swings will be there if you're part of the game. So you're not losing money per se. It's part of the game and the swings that you have to endure to get to where you want to go and whatever that is that people want to go. If it's buying a house or buying a car or retirement or whatever it is. And if you're trying to take big swings where you want to try to 10, 20, 30x your money, you're going to get larger volatility with those moves. It's just the way it is. It's part of the game. And you got to learn the game and be able to handle those swings if you're trying to go for those large returns. Peter Schiff, the best dips to buy this morning are in gold and silver, which I agree with, as well as the precious metals mining companies. Recession and a stock market crash mean the federal deficits and money supply will soar. He's talking about the future. Real interest rates and the dollar will plunge as nominal rates fall and inflation rises. I read that and I was like, I actually agree with basically everything he said here. There's some things that I disagree with that people have opinions on, but that one I think he's pretty much nuts on that one. I do think he's pretty nuts on there. And someone forwarded this to me. He said, remember this, gold held up a lot better than crypto. And they were saying this was the death blow to gold. We'll see, is what I'll say there. ICE vehicle sales are up 7%. Electric car sales plummeted 37% in Germany as the slump deepens, according to Bloomberg. So Germany electric vehicle sales slumped in July, extending a broad pullback since incentives ended late last year. and undermining automakers' plans in the EV shift. So that's what we've got there. So sales of vehicles without the plug gained 7%, which is ICE vehicles. Holger says the US 2 and 10s yield spread is now flat for the first time since 2022 on aggressive repricing of Fed rate cuts. The US 2-year yield have plunged by 70 basis points to 3.69% since last Wednesday, while US 10-year yields only dropped by 40 basis points in the same time. So what this means is when you get above this zero rate, where the 2-year and the 10-year equal each other, that's generally when people throw in the towel, so to speak. Like it's a recession, it's a slowdown. Um, we're going to get some cuts of yields. The Fed funds will be cut by some amount. Don't know what those are, but yeah, that's kind of what people think. That's also what I think, and that's generally when you see the market start to sell off, and that's exactly what we're seeing. we're seeing the sell off stage, and this could continue. The selling pressure could continue. We'll have to wait and see what it looks like. And a lot of the times you get a stair stepping lower. So don't be too quick to jump on it if the yield curve continues to steepen or uninvert. And it may take some time, so be patient. Charlie says the VIX is at 65 right now, up from 23 at Friday's close. If that were to hold, it would be the biggest one-day percent increase in history and one of the highest closes ever. Only periods with higher levels of implied volatility were October, November of 2008, the great financial crisis, and March of 2020. So maybe we are getting close to the end of this volatility. I mean, look how big this is compared to history. So maybe we're getting close, maybe we're not. We'll have to wait and see. But it is a big selling pressure event when compared to history. It is. So this is, these are pretty volatile days. Kobayashi letter says breaking. It has now been 1.5 hours since the market opened, and users at Schwab, Vanguard, Fidelity, Ameritrade, and E-Trade are still unable to access their accounts. The volatility index, VIX, just hit its third highest level in history. Yet retail traders are unable to buy or sell. That did occur. I tried. Someone made that comment, and I tried logging in, and I couldn't log in. So we were kind of all blocked out. It looks like. I'm buying more stocks today. What is his thesis? So his thesis is I can stay retarded longer than the market can stay solvent. Just thought that was funny. I read that and I had to share it. Sorry, guys. I just had to. Calvin says the market is getting to get an absolutely insane income for your retirement. Commodity companies are very cheap, many sporting double-digit yields. Extended deflationary crash. Federal interest payments are the largest line item in the budget. The path forward is currency devaluation. Now I realize that there's a lot of pressure here in the short term, but just look ahead in months and years. Resource companies are the only place in the market that are screaming value right now. I agree with that. And that's why I'm here. That's why I'm in the resource companies, is because that's where the value's at. I don't determine that, the market does. And I just go where the value is located. Completely right. And this volatility is giving us an opportunity to buy shares at cheaper prices. The only thing that I would say is we do have the yield curve uninverting. There could be a slowdown, and we don't know the extent of that slowdown yet. But this is an opportunity. It really is. Investment wisdom, Peter Lynch. I love volatility. Human nature hasn't changed a lot in 25,000 years. Some event will come out of left field and the market will go down. Volatility will occur. That presents a great opportunity. And that's very similar to what Calvin Froge said as well. Another one says the stock market is only market where things go on sale and all the customers run out of the store. It says Cullen Roach. It's true. Everybody's been running around like a chicken with their head cut off. Here's the Goldman Panic Index is flashing panic. Past times were close to fairly major lows. So if we look at this panic here, panic, 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 and panic. Low, 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 and low. So this is probably a good time to maybe get in there and start causing some sprinkling, is what I call it. Maybe. I like to wait for the turn first and then go at it. North Star, major market event red alert. Can it be contained for a period of time? Question mark. Will we be able to de-escalate in a few days? Possibly, but we are entering a high risk period now as capital rotation forces begin to exert themselves. It's talking about the 10 and 2 yield curve coming on up and uninverting, like we've seen. And there's a lot of the dot-com bust was here. It uninverted. We had a OFC subprime coming up. We had this repo liquidity COVID event. We've come back down almost to like a retest here, and now we're coming back up. It says if you keep your head and you have some cash, this is the time you can scoop up some massive yields. Some high quality stocks with rock solid balance sheets are yielding over 10%. There's a lot of commodity companies that are doing that, and I think everyone on the website knows those companies. We're in them. We are collecting those dividends, and yes, they can be scooped up today for cheaper prices, and the yields are really good on them. They're really good. Energy Cynic says, I'm an energy bull. Take it for what you will. When tech crashed in 2001, I remember the common investor reframe. No more tech nonsense. I want to invest in real assets. Triggered a repositioning into materials, energy, etc. The narrative follows price, which follows flows. And the flows are about to change where we go into materials, energy, etc. It's coming, guys. And that's part of the cycle. It's part of the cycle. And that's where we go through these cycles. We go and transition into an expansionary phase of real estate and all that. It's going to come, but we might have to cycle back through a slowdown as money repositions in the market. Completely agree. Here's Douglas. Again, we're talking about the VIX here. According to the VIX, the worst market events of our lives were in 2008 financial crisis and COVID, and the Bank of Japan raising interest rates by a quarter percentage point. It's kind of funny because we have the 2008 financial crash, which is here, the COVID crash here, and then the Bank of Japan raising interest rates by a quarter of a percentage point, causing this. It's glorious. I'm sure Calvin's pretty happy about the tech sector finally maybe rolling over. Microsoft, Apple, Meta, all those. Now this was probably earlier in the day because looks like it was a little bit older post, but these did end quite low still. And that's what we've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website, and we'll catch you guys next time. This is Finding Value.